Hi, my name is John Palmer, Senior Vice President and Lead Portfolio Manager for Real Estate Strategies at Westwood. I wanted to take a couple minutes to share my thoughts on the REIT market for the month of March, but as usual, I'll preface my REIT industry comments with a quick few observations about the macro environment. Following two steady months of equity market returns to kick off 2026, March provided a big reversal, with the S&P 500 index finishing down nearly 5% for the month and the Nasdaq index finishing down 4.7% for the month. Credit markets fared a little bit better as investment grade credit was down only 1.8 and high yield was even better than that, down 1.1%. We'll go deeper into the REIT market performance a little later in the video. By far the biggest driver of this negative performance stems from the military operations in Iran that began on February 28th. What was once thought to be a shorter-term military engagement has now spilled into its second month, with further escalation likely. And with the Strait of Hormuz effectively shut down, the price of oil has skyrocketed to over $110 per barrel, and the knock-on effects of this energy crisis have negatively impacted prices across the board. We will get the next inflation report in a few days, but consensus estimates are predicting year-over-year inflation coming in at around 3.4%, materially higher than February's 2.4% print. A second key area of emphasis that investors are watching closely is the U.S. labor market. Last Friday's jobs report showed a stronger than expected rebound, with U.S. employers adding 178,000 jobs and the unemployment rate dipping to 4.3%. This performance indicated a robust labor market recovery, reversing a weak February with significant job gains coming in the healthcare and construction sectors in particular. So this combination of higher inflation and robust hiring really placed the Fed in a tough spot with regard to interest rates and President Trump's desire to see the Fed initiate further interest rate cuts. Complicating the policy picture even further is the ongoing dispute between the Trump Justice Department and its investigation into Fed Chairman Jerome Powell. Senator Thom Tillis has indicated that he will not allow Kevin Warsh's appointment to go forward until the Powell investigation is complete, potentially delaying President Trump's new Fed chair from taking office. This makes it even harder to forecast the forward path of interest rates, but we will be watching closely. With that macro commentary behind us, let's move on specifically to real estate. On the first slide, we showed the 10-year Treasury chart since the beginning of the year. The 10-year started 2026 at 4.17% and ended March at 4.32%. So we've only seen about 15 basis points of yield increase since the beginning of the year. However, when you measure from the February 27th low of 3.94%, the yield change is closer to 40 basis points. Switching to REITs, on the next chart, you'll see the March performance for the MSCI US REIT Index. Generally speaking, REITs had a really difficult March, posting a negative 5.7% return, underperforming the S&P and the Nasdaq and cutting their year-to-date return by over half. Next, I thought it would be helpful to put the March performance in context with the broader market. On the next chart, I've broken out the S&P 500 index into its 11 GICS sectors. As you can see, the REITs in the S&P 500 index produced a middle-of-the-pack return for the month of March. Not surprisingly, energy significantly outperformed for the month, but every other industry sector was negative for March. On the next chart, we highlight the March REIT market performance by property sectors. As I stated earlier, March was a fairly weak month for REITs, with every property sector except for data centers posting negative returns for the month. In addition to data centers, the other top performers were timber and commercial mortgage REITs, while self-storage, infrastructure, specialty REITs, and net lease lagged for the month. Lastly, I thought it would be helpful to show the change in valuations from the beginning of the year. As you can see on this last slide, implied cap rates for the most part have remained fairly steady on a year-to-date basis. However, the noticeable sectors would be regional malls, industrial, office, and single-family rental REITs, which have seen cap rates widen a little bit, while data centers, shopping centers, and self-storage have seen a bit of cap rate compression. But the overall implied cap rates for the REIT market currently sit in the mid-sixes, which still remains a little wide to long-term historical averages. As always, thank you for your time, and if you have any other questions, feel free to reach out to Westwood directly. I look forward to sharing additional updates with you in the future.